The offshore threat has forced a change in the Reserve Bank's interest rate approach. For the second month in a row, the RBA board kept interest rates on hold, citing global market concerns about Europe's debt problems, softer data in the US and moderating growth in China. The caution was balanced, though, by bullish expectations of Australia's trade performance and hopes of a pickup in business investment. Philip Lasker reports.
Ease the squeeze. When do we want it now?
They were calling for rate cuts at the Reserve Bank, but not inside the building. The RBA board kept the official rate at 4.5% for a second month. Given market fears about Europe's debt crisis and weaker American data, the board said the interest rate setting was appropriate.
At the end of the day, they're saying rates are already on average and they've got time to sit and wait, and they're going to watch to see what happens both locally and internationally.
Domestically, the RBA did see very strong terms of trade boosting national income. Figures out today saw exports of gold, iron ore, coal and wheat deliver a May trade surplus over $1.6 billion. That's the third highest on record. The April surplus was also revised up significantly. But the RBA was looking at more than just trade.
The household sector is a bigger part of the economy, and right now, as the Reserve Bank notes, it's showing signs of caution.
And a survey from consultants Dun & Bradstreet showed business confidence has dipped for the first time in months. It's that mixed picture which had the Reserve Bank backing away from last meeting's conclusion that interest rates are appropriate for the near term to simply appropriate. The bank acknowledged inflation numbers due out later this month and demand would be important considerations for interest rate settings. But it also acknowledged higher taxes and charges would lift headline inflation above its 3% comfort zone.
Maybe you get the message that they see these as temporary, and that maybe if you get a bad CPI in July, they might not go. But their fundamental problem is that they're still expecting core inflation to probably get just a touch below 3 and not really go much lower. So the message is still they're concerned about inflation.
A few months ago, I think most of us thought that phase 2 of the tightening cycle would probably begin this year, but the big downshift in global equity markets and the worries about double dips in the US and Europe, and worries about a big Chinese slowdown, all just worries at this stage. I think those sorts of things have added into the equation and have the Reserve Bank sort of less likely to move this year.
Although a majority of analysts think borrowers are safe from higher interest rates until at least November.